Welcome to TradeLog AI Academy. Today we're covering a skill that separates pros from noise traders: time frame alignment. Reading 4-hour, 1-hour, 15-minute, 5-minute, and 1-minute together. Time frame alignment means multiple charts for the same asset are pointing in the same directional bias. Think of it like weather. The higher time frame is the climate, the mid time frame is the daily forecast, and the lower time frame is a gust of wind. You don't trade the gust against the climate. Here's the hierarchy. 4-hour defines context and main trend. 1-hour defines current bias and key zones. 15-minute narrows focus into a trigger area. 5-minute executes. 1-minute refines the exact entry. Analysis flows top-down. Execution flows bottom-up. Your higher time frame bias is not a feeling. It's a structural fact. Define it with two things: market structure and key levels. Higher highs and higher lows is bullish structure. Lower highs and lower lows is bearish structure. A conflict is when the lower time frame moves against the higher time frame bias. For example, 4-hour can be bearish while 15-minute looks bullish. Often that's just a pullback or consolidation before the next 4-hour move. Your job is to recognize it early and avoid forcing trades. When timeframes conflict, you have two professional options. Option 1. Trade with the higher time frame. Wait for the lower time frame to realign. Option 2. Stand down. If you're uncertain, the best trade is no trade. Counter-trend trades are the exception, not the rule. They're only valid at a major 4-hour or daily level, and only with clear lower time frame confirmation, like a reversal signal or structure break. And your risk must be clearly defined by that higher time frame level. Confluence is when multiple factors align at the same price zone, creating a higher probability setup. Your goal is to find stacked levels, a 4-hour level supported by 1-hour structure, refined by a 15-minute zone. That's where you get clean trades with defined risk. The ideal entry is simple: HTF direction plus an LTF trigger. Price reaches the 4-hour zone. You wait for a clean signal on 5-minute, like a retest and continuation. Then you execute. This is how you avoid emotional entries and trade with structure. Stops must invalidate the trade idea, not just a small 1-minute fluctuation. Place your stop based on higher time frame structure, below the swing low that confirms the uptrend or above the swing high that confirms the downtrend. A tight stop just because you entered on 1 minute is not risk management, it's self-sabotage. Management depends on alignment. When 4-hour, 1-hour, and 15-minute agree, you can hold for higher time frame targets and let the trade work. In partial conflict, reduce size, take profits faster, or simply wait for full alignment. The 1-minute and 5-minute charts are for execution only, not analysis. Never form your bias on 1-minute or 5-minute. Only go to the lower time frames when price reaches a pre-planned higher time frame level. If you feel anxious, zoom out to 1-hour or 4-hour to regain perspective. Common mistakes are predictable: marrying the 15-minute trend, believing a 5-minute level will stop a 4-hour trend, or using timeframes that are too close together. The fix is just as clear. Start on 4-hour, respect hierarchy, and keep meaningful spacing between timeframes. Here's your pre-trade scan. 1. Determine the main 4-hour trend. 2. Check if 1-hour agrees. 3. Mark key higher time frame zones. 4. Wait for price to arrive. Patience is a strategy. 5. Find the lower time frame trigger and execute. Remember this: higher time frame sets the game. Lower time frame times the move. If you want consistency, you need consistent process. Log your alignment in TradeLog AI, and you'll see exactly what works when it works.